Hello and welcome. Under financial statements, today we are going to discuss about depreciation, amortization and bit about owner's equity. We are going to define what depreciation is, and then different methods of depreciation. We will show an example and then talk briefly about owner's equity. Owner's equity will be discussed in detail when we talk about funding new ventures. Funding is separate session. There will be several sessions on funding new ventures. So, we will discuss in details, but for the time being, to understand balance sheet, we need to introduce these terms. That is why we are discussing now. Depreciation is actually the money that you invest to procure fixed asset. So, you incur cost to procure fixed asset, and then gradually you charge your profit loss account in a gradual manner by a small amount with a defined small amount. The bookish definition should be like this: depreciation is an accounting method, meaning it is part of the accounting through which a gradual allocation of the cost incurred to acquire tangible assets, particularly tangible asset, as expense, and then charge it to the profit loss account over its useful life. So, there are different constructs in this definition. We will discuss them moving forward. Businesses depreciate long term assets differently for two different accounting purposes. One is for tax purpose, another is for reporting to stakeholders. For income tax purpose, actually every government, like Government of India, they allow different kinds of depreciation to promote investment in different asset classes. Like suppose some companies are polluting the environment. So, Government of India may very well allow 100% depreciation or 50% depreciation against assets that are procured to alleviate or ameliorate pollution. So, for that particular purpose, they will depreciate those assets at an accelerated pace, so that their income tax obligation reduces, whereas this will not actually tell the real performance. So, to estimate the real performance, there is a method of depreciation for which is normally followed across all companies, and for any kind of external reporting, like reporting to bank, reporting to investors, companies or businesses follow a very uniform kinds of depreciation, and then that depreciation may be lower compared to what they follow for income tax purposes. So, there are two different sets of books of accounts, or say financial statements. Like there will be one set of financial statements showing different kind of profits, and that will be submitted to Government of India for income tax purpose. There will be another set of financial statements that will be presented before the investors and bankers and all of the stakeholders, like even your suppliers are stakeholders, your buyers are stakeholders, your employees are stakeholders, co-founders are stakeholders. Everybody who has something to take or give are all stakeholders. Suppose you buy a Xerox machine for 1 lakh rupees, just to give you some idea as to why depreciation, and if you do not consider what happens, etc., etc. So, you estimate that you can make something like 5 lakh copies out of this machine. Hypothetically, you can actually make much more. Your toner cost, as per suppliers or the machine, they might say that okay, 30 paisa will be your toner cost. So, rest is your profit, or out of the rest of the money that you charge the customer, maybe 60 paisa, 70 paisa or something, you have to manage your remaining cost as well as profit. So, you are to incur something like, you estimate that there will be something like 50,000 rupees towards labor cost and other costs during the life of this machine. Say life is say 5 years, the figures are not realistic. Just to drive home the point, you feel that you can charge the customer at the rate of 60 paisa per copy. So, your total income will be 5 lakh copy multiplied by 60 paisa, so 3 lakh rupees, and your total expenses will be something like starting from toner cost is 1,50,000, labor and other cost is 50,000. So, total cost is 2 lakh rupees, and your income is 3 lakh rupees, and you think that your profit is 1 lakh rupees. But now you have to, means you might forget that you have procured the machine for 1 lakh rupees, that is also a part of the expense. Depreciation actually takes care of that, meaning every year you allocate a portion of your procurement cost or purchase cost of the machine. Maybe during 5 years, if you think that okay, 20,000 is my allocation towards cost of the machine, then along with other cost you will be allocating 20,000. Let us move forward and look at it. Through depreciation, the capital asset procurement costs are gradually charged in the profit loss account. Another way of looking at it is like this: depreciation actually takes care of the wear and tear of the machine over its useful life, meaning the machine is gradually reducing its value. So, you charge that reduction of the value to profit loss account. Alternately, the flip side is that you can very well consider that this is an expense, it is actually expenditure. This is an expenditure that you can always think that okay, let me charge on the profit loss account, because whatever you charge on the profit loss accounts are expenditure. So, you can think that okay, let me charge. So, what happens is in the first year itself you charge the entire cost of the machine, then your profit will go down drastically, and next year there is no depreciation because everything has been charged. So, profit will shoot up. Again you buy a machine, again you depreciate it fully, so profit will go down. So, there will be enormous volatility in your bottom line or profit, which will not disseminate a good message to the external world, like bankers, or when profit is high they will think you are doing kind of wonderful, when profit will go down they will think something alarming is happening, etc., etc. You want to maintain stability, and people should think that your company is a stable company. Otherwise, shooting up profit, shooting down profit, both are not really taken very politely. Stability is the order, means everyone should try to remain stable in both top line and bottom line. Top line is the sales, bottom line is the profit. Now, methodology, actually from the example of this Xerox machine, now you know the complexity. You cannot actually charge the entire Xerox machine cost as depreciation in the first year itself. Then you will end up pricing your per copy Xeroxing fees very high, because the cost is going to be very high. So, there has to be uniformity in the from that point of view. So, thankfully there are methods for depreciation. There are many methods actually. I have just placed it 4, but I will be discussing only 2: straight line method of depreciation and declining balance method of depreciation. Some of years digit methods are there, but let us not go into complexity. Let us understand the philosophy and then how to apply. Then you can always apply any methods that are there. Units of production, some of years. Okay, let us move forward, then if time permits we will discuss. Straight line method. Straight line method applies uniform amount or equal amount of depreciation every year. In the case of this Xerox machine, suppose you think that after 5 years you can sell the Xerox machine for say 20,000 rupees. So, 20,000 rupees will come back. What will not come back is 80,000 rupees, 1 lakh minus 20,000. So, you want to depreciate evenly, means every year you want to depreciate equal amount. So, 1 lakh is your purchase price, 20,000 rupees will be recovered later. So, 80,000 rupees will be depreciated evenly during 5 years. So, it will be 16,000 rupees every year, something like that. That is the concept. So, in a straight line method, an asset is evenly depreciated or equal amount of depreciation each year over its useful life. For a particular asset, same amount of depreciation is allocated as expense during each year of useful life in the profit loss account. So, the formula is like this. It is obvious, means whatever I explained, formula should emerge from there. Depreciation under a straight line method is equal to procurement cost minus salvage value, that is the Xerox machine cost was 1 lakh minus salvage value is the value that you estimate that you will realize by selling the asset after its useful life. If you think that the Xerox machine after 5 years of useful life can be sold for 20,000 rupees, that 20,000 rupees is the salvage value or terminal value. In some text it will be written terminal value. So, procurement cost was 1 lakh rupees, salvage value was 20,000 rupees divided by useful life. Useful life is 5 years in this case. Useful life and salvage value are subjectively decided, meaning that there is no formula. For a Xerox machine, it may go for 6 years, 7 years, 5 years, 10 years, it is up to you to decide, and then you depreciate accordingly. And then there should be logic behind it. You cannot just think that Xerox machine will run for 2 years, that will not be acceptable. For every machine there will be some kind of benchmark or some kind of traditional approaches for understanding the life of the machine, and then there should be a logic behind determining of salvage value. Now, suppose you buy an asset for 10,000 rupees in 2016, and then you make a fair assessment that the asset will last for 5 years. So, that is your useful life. Now, you assess that after 5 years you will be able to sell the machine for 2,000. That is the salvage value. After 5 years, whatever you realize is a salvage value. Therefore, depreciation every year will be is equal to 10,000 is the procurement cost, 2,000 rupees is the salvage value, becomes 8,000 divided by 5 is equal to 16,000 is the annual depreciation. Now, you will allocate 1600 rupees every year over this 5 years as depreciation in profit loss account. So, starting from 2016, 17, 18, 19, 20, this is the depreciation. Book value at the beginning of the year is the procurement cost. So, that was 10,000. The depreciation is 1600 across 5 years every year. So, every year you estimate 10,000 rupees is the beginning book value, you deduct depreciation, then you get the book value at the end of the year, at the beginning of the year, at the end of the year. During the year you depreciate because of wear and tear of the machine during the year of operation. So, book value in the balance sheet of the current year, meaning at the end of the year, that is means on the last day of the current year, will be 8,400 in 2016. Next year opening value is 8,400 because that was the closing value, book value last year. But then during the year your asset is going to be depreciated by 1600 rupees. So, at the end of the year when you prepare the balance sheet as on the last working day, close of business of the last working day, the book value of this asset will be original value or not original value, the beginning book value minus depreciation is equal to 6,800. So, every year in the balance sheet you will show the net value, that is book value minus depreciation, book value at the beginning minus depreciation. There is a concept of accumulated depreciation. I will come to that moving forward very soon. So, how to estimate book value under straight line method? These are the steps. Everything has already been discussed. Let us not go. This is how the book value reduces in a very straight line manner, and that is why it is a straight line method. Declining balance method means every year value of depreciation reduces. Earlier method, a straight line method, every year depreciation was the same. This time depreciation is a percentage of book value. Depreciation is charged at a fixed percentage. Look at the underlined text, fixed percentage. Earlier in a straight line method we saw depreciation is equal amount, but here it is fixed percentage of the opening book value, fixed percentage of the opening book value of the asset. So, same case, now it is declining value method. Suppose we say that here the percentage has to be decided, at what percentage you estimate book value depreciation. So, here I have taken 20%. It can be 10% depending on the type of asset and depending on your policy, meaning that you cannot change depreciation rate or method of depreciation frequently at will. You have to follow stable policy, accounting policy, meaning that if you follow that, if you decide that I followed declining balance method of depreciation, you have to follow continuously that, otherwise your profit will be affected and that will send a wrong signal to the investor, to the external community. So, follow stable method. If you follow 20% depreciation for a particular asset, follow that, 10% follow that. Now, you procure, remember that for declining balance method there is no salvage value concept. It is just a percentage of the opening book value. So, in the first year opening book value is the procurement cost. You allow 20% depreciation, that becomes 2000 rupees, minus 10,000 minus 2000 is 8,000 rupees. So, that is the book value as on the close of business during this year. Whatever depreciation you have allowed so long, that is the accumulated depreciation. In the next year, your opening value of this fixed asset is 8,000 rupees, which was the closing book value last year, and then you allow 20% depreciation on the opening value of the book, opening book value of the asset, which was 8,000 rupees. So, depreciation becomes 16,000 rupees. In a straight line method it is same, but this time it is different from the previous year. So, deduct depreciation from opening book value, you get 6,400 rupees. Now, earlier year your depreciation was 2,000, this year your depreciation is 1,600. So, total depreciation is 2,000 plus 1,600 is 3,600, which is called accumulated depreciation. Next year your opening book value of the fixed asset is 6,400, you allow 20% depreciation on that. So, depreciation is 1280 and closing book value is 5,120. You add this 1280 of depreciation with the accumulated depreciation of the previous year, accumulated depreciation becomes 4,880. Likewise, you move forward. Accumulated depreciation is a very important concept, and these are the steps following which you estimate depreciation and book value using declining balance method or declining value method. The distinction between the two should be understood very thoroughly, because these two methods are simultaneously used or interchangeably used. So, one should know the implication. See, first line is a straight line method, first row, second row is declining balance method. In a straight line method, fixed amount or equal amount is allowed as depreciation, whereas in declining balance method only fixed percentage of depreciation is allocated, fixed percentage of the opening book value. I am repeating this again and again, do not confuse. Second differentiation is that it must determine useful life, because equal amount will be allocated as depreciation over the useful life. So, when you start estimating depreciation on the straight line method, you need to understand what is the useful life, whereas in declining balance method there is no useful life philosophy. In fact, the asset is assumed to have perpetual life, means infinite life. If you allow depreciation as a percentage of the opening book value, the asset will never ever become 0, whereas in a straight line method it will become. Third difference is that in a straight line method there is a concept of salvage value. At the end of useful life, at whatever price you can sell, that is the salvage value. There is no such concept in declining balance method. The depreciation amount is recorded as expense in the profit loss account. This is very important. Depreciation amount is recorded as an expense in the profit loss account. It is part of operating expense. It is part of operating expense. Book value after depreciation is recorded in the balance sheet as new book value of asset. It is reported as such. The new book value of the asset is reported as such in the balance sheet. We will see that moving forward. Book value is also referred to as the net asset value or simply the net value of the asset. Okay. So, let us move forward just to demonstrate this fact. See, on the left two columns refers to profit and loss account, where you have the I have started with gross profit. The top row is the gross profit. Is the same example that we discussed in the previous session. So, the first is gross profit, then you try to estimate operating expenses, which is the sum total of all the operating expenses such as salary, then rent, transportation, then telephone expense, then electricity, then trade license fees that you incur every year, then depreciation. So, what about depreciation? The sum total of all the depreciation that you allocate for all the assets during a particular year comes here as depreciation expense, and then you make a sum total of all such expenses to arrive at operating expense, and you deduct that from gross profit to get operating profit. Whereas, in the balance sheet under asset, whatever was the asset value last year, you deduct depreciation from them and then bring it here. That is how depreciation affects value of asset in the balance sheet. That is how the treatment is made. Next is amortization. Amortization is almost the same thing. It is not different. Only difference is that depreciation refers to tangible assets. You procure fixed assets and you apportion a small amount of the cost as expense in the profit loss account. You charge in the profit loss account. Whereas, amortization refers to creation of intangible assets, mostly intangible assets, like say brand. You create a brand through advertisement, through promotion, or you do research and development and create technology, file patent, or create copyright, things like that. Or maybe say at the beginning of starting a company, you incur some expenses towards even creation of the company itself, how to bring the company into the company, like say from zero you incur something like registration expense, like lawyers expense, then chartered accountants fee, etc., and then maybe some expenses are incurred for starting say trial run of a factory, and then maybe interest expenses that is incurred during the early trial operation, maybe salary, labor cost that you incur at the beginning. Everything together you make preliminary, you term that as preliminary pre-operative expense, and you apportion that over a period of time. You decide that I will recover, or I will apply that over a period of 10 years maybe. Suppose your preliminary pre-operative expenses or company formation expenses, everything together, suppose is say 10 lakh rupees. You decide that I will apportion that in profit loss account or charge that in profit loss account over 10 years, maybe equally, maybe in a staggered manner, meaning that first year you charge maybe 3 lakh rupees, next year say 2.5, next year 2 lakhs, next year 1.5, 1 lakh, likewise, or maybe equally 1 lakh each year. So, it depends on you, and you give an explanation why you are thinking this way. You can even do it other way around. First year 50,000 because profit is less, next year 1.5, next year 1 lakh, 1.5, then gradually increase, and in the process you charge the entire preliminary pre-operative expenses over a period of 10 years. For research and development, you do it other way around. There is no hard and fast rule of the company. Most common amortization expenses refers to advertisement, promotional expenses, research and development expense, preliminary, pre-operative, etc. There is another term almost like amortization and depreciation. Is not really so much of a technical term, but for very specific companies this is used, called depletion. Suppose you have a license for an iron ore mine or any other mine. So, it has a proven reserves of say suppose 1 million ton or say 1 million ton for argument's sake. Now, every year suppose you are extracting or digging out say 1 lakh ton. That means the life of the mine will be 10 years. After 10 years, there will be no money, no iron ore. Every year, if you extract 1 million, 1 lakh ton, so you may actually, suppose you have invested something like say 10 lakh rupees to get the license. So every year you allocate 1 lakh rupees. So that is called depletion, the value depletion. It is equally charged. Just to give you an idea about how they are correlated, this depreciation, amortization with profit loss account, I have already given that example, only that amortization was not mentioned. So you estimate, you find out the sales or revenue from all sources, then you subtract cost of goods sold, you get gross profit, then you deduct all the operational expenses like salaries, including depreciation and amortization and other operational expenses, you get operating profit. Then you get, after operating profit, you deduct interest and other finance costs, then you get profit before tax, you allocate tax, you get net profit, then you deduct dividend, you get retained profit or retained earning. This is carried forward to the balance sheet as retained earning or reserves and surplus. We will discuss that. Next item in the discussion is owner's equity. It is not so much related to depreciation, but I thought we will be discussing different constructs of financial statements one by one, and then we will combine them together. Owner's equity or owner's capital, it should be owner's equity actually. Owner's equity is a very significant construct in balance sheet. In the liability side of the balance sheet, the first part is liabilities and the second part is owner's equity. So, let us go in detail into owner's equity. See, when you start a company, whatever money you bring in, that is your equity. If you are alone, then it is your equity. If you are say 3 guys forming a private limited company, then all the 3 people, whatever money they bring, sum total of the money becomes owner's equity. Now, suppose in the first year you make a profit, suppose you bring in 10 lakh rupees, 3 guys together. So, owner's equity is 10 lakh. Suppose you operate the business for a year, you make a profit of 1 lakh rupees and then you pay dividend of say 50,000 among you 3 guys. What remains is another 50,000 out of 1 lakh rupees. That 50,000 will be added to the owner's capital or owner's equity in the form of reserves and surplus. So, in the next year when you write owner's equity, the first item will be equity capital 10 lakh that you brought at the beginning, second item will be retained earnings or say reserves and surplus 50,000 rupees, so total will be 10 lakh 50,000 rupees. That is how part of the net profit is added. Now, another confusion that majority of the new entrepreneurs have is percentage holding. So, let us see, it is a very intuitive and there is nothing big about it, but still founders holding. I gave an example of 10 lakh rupees. Suppose you 3 guys started A, B, C for the lack of names. Suppose A, B, C are 3 guys, they start a company, they bring in say 10 lakh rupees. Say A brings in say 2 lakh rupees, B brings in 5 lakh rupees, C brings in 3 lakh rupees. There is a concept of par value of shares, meaning you hold some shares in the company. What are they? When you bring in 10 lakh rupees total, then you decide that let us define a par value of share, meaning let us distribute this 10 lakh rupees among some shares. You decide that okay, each share will have a face value or par value of rupees 10, meaning that one share is equal to 10 rupees paid up, meaning you have already paid. So, you brought in 10 lakh rupees, so total is 1 lakh shares. So, you have 1 lakh shares. Now, whosoever has brought 2 lakh rupees, he gets 20,000 shares. Who brought 5 lakh rupees, he gets 50,000 shares. 50,000 shares into 10 rupees each is 5 lakh share. So, what is the holding? Total number of shares is 1 lakh. Now, A holds 20,000 shares. 20,000 divided by 1 lakh is 20%. 50,000 divided by 1 lakh is 50%. Likewise 30%. So, you 3 guys now hold 20%, 50%, 30% respectively among A, B, C. Now, suppose you raise some money and an investor chips in something like 1 crore rupees, and he says that I want post investment, I want 20% of the equity. So, now he has 20% of the equity, irrespective of the number or whatever, how you decide number and whatever is that. You decide is like this, that he has to get, he or she, whosoever is the investor, gets 20% of the equity, and your equity will go down proportionately. That means, after 20%, what is left is 80%. So, you get 80% of whatever you had. So, 16, 40, 24 plus 20 makes 100%. That is what is dilution. We will see about dilution and equity in different rounds of fundraising when we talk about fundraising per se. Now, one concluding remarks is that a straight line method of depreciation is normally the default method. When nobody mentioned about anything, you consider that it is a straight line method. Depreciation and amortization are non-cash expenses, very important to know that. So, it is just a book entry because the expenses are already incurred at some point of time, you are merely allocating in profit loss account. So, when no cash actually goes out when you amortize, you allocate amortization. And when somebody talks about net profit, that is profit minus income tax, but then this profit is net of depreciation. Now, when somebody talks about cash profit, you add back depreciation and amortization with net profit to get cash profit. Cash profit is another concept which is relevant in case of cash flow, but otherwise also cash profit is a very important terminology in accounting. People talk about net profit and cash profit. If you are an investor in stock market, you will see cash earning per share and net earning per share, EPS, and cash EPS, CPS. We will discuss about that at some other point. Thank you.